Fed just cut rates. What should you do? In the next 6 minutes, I'll give you 5 practical moves to protect your cash, reduce cost of debt, and spot new opportunities. No jargon. Let's get started. What happened? Fact Site. This week, the Federal Reserve lowered the federal funds rate by 25 basis points, taking the target range to about 4.00% to 4.25%. That's the Fed's September 2025 decision, and it's the first meaningful easing after months of higher rates. Why it matters? Brief explanation plus reason. Cite. Why does this matter? The Fed sets short-term policy to manage inflation and jobs. Officials said the labor market has weakened enough to justify a modest easing, so borrowing costs for many could start to fall, though changes for mortgages and credit cards can lag. Transition to actions. Here are 5 smart moves you can actually do in the next few days or weeks. Ranked from defensive to opportunity-focused. Move 1. Check and top up your emergency fund. Defensive. Why? Rate cuts don't fix job risk overnight. Goal: 3 to 6 months of essential expenses in cash or ultra-short instruments. Action: if you have under 3 months saved, redirect a portion of each paycheck to a separate savings account and automate it today. Move 2. Revisit high-interest debt strategy. Save money fast. Why? A lower Fed rate often means banks gradually reduce variable loan rates. Action: make a priority list of debts. Pay down credit cards, still often highest rates, then high-rate personal loans. If your variable rate loans drop, consider refinancing or negotiating a lower rate. Even a small cut can save big over time. Move 2. Attack high-rate debt. Move 3. Lock or shop for big fixed-rate loans carefully. Mortgage advice. Why? Mortgage rates don't always move as fast as Fed cuts, and they're driven by bond markets. Action: if you're looking to buy or refinance, get multiple rate quotes and use rate locks smartly. Consult a mortgage pro before locking if you expect another cut soon. Move 4. Rebalance portfolios. Favor quality, watch duration. Why? Rate cuts can boost growth assets, but also shift where risk lives. Action: rebalance to your target allocation. Trim assets that are overweighted and rebuy underweight positions. If you hold bond funds, check duration sensitivity. Longer duration bonds gain more when rates fall, but they also have more volatility. Move 5. Spot opportunities. Dividend stocks, selective growth, and dollar cost average. Why? Lower rates can lift equity sectors and commodities like gold and may support riskier assets. Action: identify 2 to 3 sectors you believe in. Set a plan, DCA, dollar cost averaging, and don't chase hype. Consider tax-efficient accounts for long-term buys. Quick bonus tips, 2 one-liners. Bonus number 1, if you're a saver, shop for high-yield short-term instruments. Some online banks raise promotions after cuts. Bonus number 2, review your budget. Lower borrowing costs are a chance to accelerate investments. Recap and urgency CTA. Recap: 1. Emergency fund. 2. Pay down high-rate debt. 3. Compare mortgages carefully. 4. Rebalance portfolios. 5. Dollar cost average into selective opportunities. Start with 1 action today. If you like this, hit like, subscribe, and comment which move you'll take first. Follow Finance Simplified for weekly quick finance moves. I'll link sources and a short checklist in the description. See you next video.